Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
So guys, what we're going to do tonight is Jim Whitesides is on, and I think the key topic is really 1031 exchange, but in just some brief dialogue, we were talking about other possibilities. I know something that's become more popular in the last several years is using trust because you can do some of the same things, it's just different rules. I don't know if we'll have time to get into that tonight, but we definitely want you guys to understand this process because a lot of us do have investors or invest ourselves. And quite frankly, if you understand the basics of it, it'll help you attract good investors. You can always, if something serious discussions come up with a property, I'm sure you can reach out to Jim and um, help you get that going. It's in fact, is anybody here? Let's go ahead and start the class. Raise your hand or just do a just say yes or type in the chat box if you've ever been involved in a 1031 exchange, either personally or with a client. Yeah, it's not that uncommon, guys. I've and just just since January, actually, I think there's been at least three people on the team working with a client who's doing an exchange. So, in any case, without further ado, let me introduce Jim. First off, Jim, thanks for joining us tonight. I know this is a big benefit for us to have you, so I'm really grateful that you're here.
Thank you very much. I'm glad to be here too, Gary. I'll um, be glad to help here, and like you said, after the fact, I'll be glad to help if there's any questions or follow up too. And just to keep things on track, about how much time do you want me to limit my comments to, Gary?
Yeah, we do. We try to wrap up around 8. Now, I generally stay on until it's 8:30 sometimes because there's other things people want to talk about. But the group's usually kind of active. They will engage with you. So um, I would plan on trying to finish up around 8. And if you want to, Eric and I can watch the chat box for you. You'll be able to see it too because you're obviously promoted the co-host yourself. But do you want to just take them as they come, or just go through some of the presentation first and then look for intervals to take breaks and to take questions?
Yeah, what I figured I'd do is I'll give you just a brief background on who I am and what I do, and then I would step through 1031 exchanges. And I do think it's worthwhile if we can get to it to talk a little bit about DSTs too, especially since there's
Yeah.
a number of people that know are familiar with 1031s. And what I'll do is I'll try to pause at the end of each slide and see if there's
Okay.
any questions with that. But please don't hesitate to ask questions. I'll just try to make sure I ask at the end of each slide before we move on to the next topic.
That sounds good to me. Well, feel free to go ahead and take her away, and then we'll be supporting you behind the scenes there. So,
Okay, sounds good. Well,
yeah.
thank you again, and everyone. I hope this will be useful to you. I'm Jim Whitesides. I'm with Great Point Capital, as you can see. Well, I guess you can't see yet. I guess I'll share my screen, right?
Should be able to. There you go.
You know, so I wear a few different hats. I'm with Great Point Capital. I'm also with EXP Commercial, and I do things independently on my own as well. So to give you a little bit of background and to explain why I do all those different things, let's see. I went to go way back. I went to the Naval Academy for undergraduate, and I graduated and put in time through the nuclear power program and served in submarines. So a lot of energy and engineering background. But I always had an interest in financial markets as a young man. And so I was fortunate to get started with that energy background in commodity trading in the energy sector. So early career was mostly in banking, energy trading in the banking sector. Eventually that more started in natural gas and crude oil, and that transitioned into electricity trading as that became a tradable commodity. And that's what brought me here to St. Louis, which is where I am now, to start the electricity trading for Ameren, the utility here in St. Louis. As that part of my career kind of wound to a close after the turn of the century, that's when I got involved with real estate. And I always like to say, as one does, you go from submarines to commodity trading, of course, to self-storage. That's a very straight line, right? So that's where I got my start in real estate. Started very humbly, and over about 15 years, I built a nice portfolio of self-storage properties here in the St. Louis area. Some were ground up, some were acquisitions, and past president of the Missouri Owners Association. I've been involved in the National Association as well, Owners Association. And when I sold my business, that's when I learned about 1031 exchanges. I had never done one before. I had good advice, so I thought, gee, how hard could it be? And so that's when I learned that it's easy to describe and sometimes can be a little more complicated. So that's when I did my first 1031 exchange, and that's when I got involved with DSTs as well as a part of that 1031. And I'll go into more of the detail of those in a moment. And so that brings me to kind of where I am now, which is I have three hats, basically. The first is I'm a registered rep with Great Point Capital, which is a broker-dealer, much like Schwab or Merrill Lynch or anyone else. It's just a broker-dealer that focuses on alternative investments like DSTs. That's one hat that I wear, and that includes DSTs, opportunity zones, tax credits. And then the second hat, of course, is with EXP Commercial. So some of the things I do are fairly conventional commercial agent activities, but I'm also, by and large, a resource for the other 80, 90,000 agents throughout the country and the world who have clients that have commercial activities or needs for 1031 exchanges or tax deferral or estate planning, that sort of thing. So I'm a resource for those people. That's the second hat. And the third hat is really, as I describe it, any other ground balls that get through the infield that relate to real estate that I think we can do some good with and that can help clients. So I help raise equity. I will help clients that are building the capital stack, meaning identifying non-traditional lenders for them. I have a client that's acquiring cell tower leases. So there's a variety of things that I'm involved with, including a different type of cost segregation study for developer clients and a variety of other things. So that's a little bit of my background. That's who I am. And we'll, if there's any questions, I'll take them now about any of that sort of thing. Otherwise, we'll get started on simplifying a 1031 exchange. Any questions yet?
Awesome.
All right.
Not yet, but I have to tell you this briefly. One of my first jobs, my second job actually was with the Navy in Norfolk Naval Base. I worked on the sub tender, and then they gave me a top secret security clearance, and I was a sub chaser, a tracker for the tracking Soviet subs. So I knew I liked you when I first saw you. So
I'll be darned. I'll be darned. I don't hear that every day. Someone who, well,
I
not that
know.
they don't like me, just that they
Yeah.
someone had a sub tracker before. Very cool.
Yep.
Cool. So with that said, again, I'll try to pause for questions as best I
Okay.
can. 1031 exchange is 1031 for those of you who aren't crisp on it. It's a tax rule. 1031 refers to the section of the tax code that allows for investors to defer gains when they're selling a property and reinvesting in a similar property. You might hear the term like-kind exchange. And that kind of implies that you're selling one property and buying another one of a similar nature. It's interpreted very broadly. So like-kind can really mean that the replacement property is virtually anything that you don't live in. It defers, so if you follow the, sometimes referred to as rules, but really what they are technically are they're guidelines the IRS gives investors to let them know that if you stay within these guidelines, you have safe harbor, you're very unlikely to ever have a question with the tax treatment on your return. So a 1031 exchange allows you to defer all the capital gains, all the recapture, all that sort of thing. It defers not only federal taxes, but states, alternative minimum taxes, and depreciation recapture. And if you follow all the guidelines, you'll be in good shape. And we will get to some of those guidelines too. Questions so far? All right. We'll start with what are your options when selling commercial real estate? And commercial could mean, you know, a rental home. It could mean apartments. It doesn't have to be a warehouse or something like that. I do come across people involved in real estate who, in fact, I just met a gentleman this weekend who I was talking to, and we were talking about commercial real estate. So, well, my real estate really isn't commercial. It's all going to be developed into senior homes. But that is commercial real estate. So, and even a home or a rental home can be treated as commercial property, particularly if it has revenue. And it's even better if it's in an LLC, that sort of thing, but it doesn't have to be. So your options when you sell commercial real estate, obviously the first option is to sell the property, pay any capital gains taxes, depreciation recapture, and the remaining proceeds after paying those taxes can be spent or reinvested any way you would like. So that's usually, I mentioned that first, but that's my least favorite thing to do for anyone, is to pay taxes they don't have to. The second option would be to do a 1031 exchange by selling the property. That's the relinquished property is the term. And then the replacement property is purchased. It could be, for example, if someone's selling a multifamily development, they may decide they want to buy self-storage properties. And so the replacement property is physical real estate in that regard. So that's the second option. The third option would be to do a 1031 exchange where the relinquished property is sold and the replacement property is actually in the form of a Delaware Statutory Trust. And we will talk about that in a little bit more detail in a moment, but a DST can be identified as the replacement property in a 1031 exchange. And when I sold my business, I had a combination of the two, which was the fourth option. So I sold my business, I bought 2 office buildings, and I bought half a dozen different DSTs. So it's not a one size fits all. It's not a one or the other sort of thing too. So those are the 4 basic options when doing 1031. Okay, and what's the benefit of doing all that? It's not that complicated, but there are some substantial benefits. When done properly, all the taxes are deferred, and it leaves more investment dollars. We'll have an example in a minute of what that means. More investment dollars are available to invest in the new property. You know, simply put, someone sells a property for $10 million and they pay their taxes, let's just say it's 30%. They now have $7 million left to reinvest as they wish. But if they can defer those taxes, those $3 million, now when they invest in that replacement property, they've got all 10 to grow with. So there's far more wealth accumulation before those taxes are owed. So that's a very, it's really a time value of money sort of situation. So there's a lot more potential for growth and for wealth accumulation when doing a 1031 as opposed to paying the taxes and investing the remainder. 1031 exchange can occur over and over. The term there is swap until you drop. So one can sell a commercial property, call it $1 million. It has $300,000 in debt on it. They replace that with either another commercial property or some number of DSTs, defer all their taxes, and when that investment or that property or those DSTs are sold, they can do another 1031 exchange and, you know, kick the tax can down the road again. So, for example, that's my strategy. Is the gains that I had from my business, I did a 1031 exchange into the 2 office buildings and DSTs, which I've now sold my office buildings and all in DSTs. But when those liquidate, I'll plan on doing the 1031 exchanges again over and over until someday when the day comes, I'll have a step up in base all my DSTs, just as you would in actual real estate, and I'll leave that to my heirs. And that's kind of my tax strategy for the gains in that real estate. And that's a common strategy, by the way. Questions so far?
So the accumulated effect, I mean, that basically we just keep rolling it forward, with each new purchase. But without going into a lot of the weeds, I guess, let's say you've done 5 exchanges and now your retirement years, 60s or 70s or something like that. Um, and you would just want to get out. You just want to cash out. I mean, on that final property, are there any other options there? I mean, I've heard of people moving into the property and living there for whatever the rule is, 3 to 5 years or something, and then it's like an exemption that they have. I've never done that, so I don't know that for a fact. Um, but what are the options at the end there when you're ready to just say, I'm done, just want to cash out, if any?
Well, yeah, good question. Most of the time, those 1031 exchanges would be structured in such a way, or the 1031 exchange, whether it's in property or DSTs, would be structured to provide you income. So you get to the point where you're done, you don't want to manage properties anymore, you would do a 1031 exchange into some sort of passive investment, like a DST, or passive investment like a REIT or some other structure, and generate income that way. So normally, now that doesn't have to be that way, and one can. There are circumstances, obviously, very, very different circumstances. I was working with a client 2 weeks ago that sold a farm, and they wanted to do a 1031 exchange, which we did, but they also wanted to take some of the money from that 1031 and pay off the debt on their home. They were elderly. They just wanted to wipe out their debt. They were willing to pay taxes on a part of it. And so the 1031 doesn't have to cover the entire amount of the sold property. You can take a portion of the 1031 in cash, and a portion of the sale proceeds, I should say, in cash, and do whatever it needs to be done, whether it's paying off debt or consolidating or what have you. So I think that's the way I look at it. Is there's almost always a time when an investor wants to be finished with the hands-on ownership of real estate, perhaps, and the day-to-day invest. So that's when passive investments become the replacement property for the 1031, as opposed to owning this specific real estate.
Okay.
Did that answer your question?
Awesome. It does. I didn't realize so a REIT is a viable option then.
Well, we'll talk about that, but a REIT is not 1031 eligible, but and we will cover that. But a DST is a 1031 eligible investment, passive investment.
Okay.
A real estate investment trust is not. There are benefits to them, and there are reasons why they might fit into someone's, their picture. But they might be a good fit for generating income for a particular reason, but they're not eligible for a 1031 exchange.
Gotcha. Okay. Well, let's hopefully we'll have time to talk about the DST.
Yeah.
That sounds exciting. So
great. So here's an example, of what the numbers might look like: paying taxes versus deferring taxes. So scenario A is paying the taxes on a property sale, which always just hurts my soul to have someone do that, but there are times. Versus doing a 1031 exchange. A property is purchased in both cases for $300,000. There's $50,000 of capital improvements. The property, from the time it was purchased until it was sold, there was $150,000 of depreciation. And so, the basis then, the basis is $300,000 plus the capital improvements of $150 minus the depreciation of $150, gives you an adjusted cost basis of $200,000 in both cases. And let's say that the property is then sold for $440,000. So now's where you get into the comparison point. The taxable gain in both cases is $240, and that's the difference between the sales price of $440 less the adjusted cost basis, right? So $240 is the gain. If one was to pay their taxes and then move on and then reinvest the proceeds, you have long-term capital gains of $48,000, which is 20% approximately of that $240,000. There are state taxes to pay, net investment income taxes, and then also depreciation recapture. Depreciation recapture is 25% of whatever depreciation was claimed over the life of the investment. So in this case, the investment was held for a period of time where the depreciation was $150,000. 25% of that you have to pay in taxes when you sell the property, and that comes to $37,500. So when you add all those taxes up, the net proceeds, if one were to pay the taxes, the net proceeds for your next investment are somewhere between $313,000 and $345,000. Okay?
Mm-hmm.
The alternative is to do a 1031 exchange. And that's scenario B, my favorite scenario. The long-term capital gains are deferred, state taxes are deferred, all taxes are deferred. You don't pay anything at the time of the transaction. And as a result, $440,000 is the amount that gets invested. So if we looked at this today and said, well, my options are to either walk away with $345,000 from the sale and invest that for income, or have $440,000 that I'm going to invest today and invest that for income, obviously I'm going to have a lot more income with the larger number. So it makes a huge difference. And then the difference between the two, that $100,000 or so, that grows over time. And so 10 years from now, the net difference is very, very substantial. So that's the sort of example that, and feel free to share this too, by the way, this handout with someone else, our client or anybody else that you might like to have a ready example for. Any questions with that so far?
It looks pretty darn good.
Okay. So the steps in a 1031 exchange. Day zero, the owner of the property, the investor, sells the relinquished property to a third-party buyer, and that begins what they call the identification period. And that's a 45-day period when the seller of the property has to identify the replacement properties, because again, it's an exchange, a like-kind exchange. And so you have 45 days to identify what your replacement properties are. Very important here, the sales proceeds have to be held by a qualified intermediary, a QI. Basically, the IRS says you can't sell a property, put the money in one pocket, and then take it out of that pocket to buy something else later. Doesn't work. You can't take constructive receipt of the proceeds. So qualified intermediary is just a fancy name. It could be a lawyer, but there are, generally speaking, there are those in the business of being qualified intermediaries. They're not expensive. It could be a title company. They will hold the money, the money from the sale. They will document the process. They will document what the identified replacement properties are, and they will complete the 1031 exchange and provide all the paperwork the investor needs so that they can submit that with their tax return, and the IRS will be off their back. So day zero is when the investor sells their property, the identification period begins. You have 45 days to shop for a new property or identify a replacement such as a DST. At the end of 45 days, obviously the identification period ends, and the qualified intermediary then might use the proceeds that they're holding in trust, in a trust account, to purchase the replacement property on behalf of the investor. And that's the way it kind of works. The QI takes the money in from the sale, holds onto it, and then executes the purchase in the name of the investor. Okay, so that's kind of the mechanism for it. And so there's a 45-day period to identify the replacement property or properties, and then 180 days to actually close. So 45 days to say, these are the properties that I intend to purchase, and then you have a period of time up to 6 months to close on some number of those. The question, how much do we need to pay for a QI? Not very much. So on the order of maybe $1,500 plus or minus. The cost of a QI is pretty low, but it is important to get an experienced one. A number, there can be complications, or there can be wrinkles in the fabric when it comes to completing a 1031. And so I'm happy to give recommendations. They don't have to be in the investor's hometown. They don't have to be local. It's all done by phone and by electronically anyways. So that's what a QI does. And the next question is, what if the investor cannot find a replacement property in 45 days? Well, if you don't identify a replacement property, then you can't complete the 1031 exchange. You're going to owe the taxes. And if you identify properties in 45 days, but you don't close within 180, same thing applies. You can't do a 1031 exchange. The transaction will be taxable.
Hi, I just want to take a moment to thank you for watching a recording of the Monday Night Live class. Hope you're getting a lot out of it. I'm sure you will. I wanted to let you know that, you can come to Monday Night Live whenever you want, but you can also participate more with the team. Why don't you set up a call with me, a one-on-one strategy call? I can go over everything with you, show you everything that we have to offer. For example, did you know that on our team, not only do you get your leads, we actually give you your own account on our lead gen system. So this puts you in control. You're not waiting on somebody to hand you leads. You get to pick the ones you want. Okay. Huge difference. We have 21 of our own proprietary marketing campaigns. They're all copyright protected. We're the only ones that can use them. Okay. The coaching is absolutely one-on-one. We got 3 coaches. We even have a 4th success coach that we have access to. Okay. One of left fewer than 100 in the world. Okay. One-on-one coaching. Right now the big problem is volume. We need more transactions. We need more inventory. I get it. Well, we know how to get it. Our team actually outproduces the national average by more than 2 to 1. So if you're struggling, don't do that anymore. If you're a solo agent, if you're a team, let's just talk. Smart entrepreneurs are always open to discussion. Learn what we have to offer, and then you can make an informed decision about staying where you are or moving on. You've got to decide, if you're not where you want to be, you've got to take action to get where you want to be. Let's see how we can help you do that. I look forward to talking to you. Click on the link, set up a call. And by the way, I'll see you on the next Monday Night Live. Now, it's the 180 days. Does that begin at the end of the 45-day period, or is that inclusive?
Includes. So
Yep.
Day 0 is when the property is sold, 45-day identification, then an additional 135 to actually close.
Yeah. Okay. Smaller properties, it's have to be easier. There's going to be more opportunities, but on the bigger you get, the bigger the properties. Well, that's got to be a real challenge sometimes, So.
It sure can, and there's a number of things that come up. For example, to use your example of a bigger property, if the relinquished property is $10 million and there's $3 million of debt, sometimes it's not easy to find, exactly that amount. You have to spend on the replacement property all of the money you take in from the sale,
Mm-hmm.
and you have to have at least as much debt on the replacement property as you have on the relinquished property. So in my example, if you sell a property for $10 million that has $3 million in debt, your replacement has to be worth at least $10 million with at least $3 million in debt. Now, that's in order to defer all the taxes. If, for example, the replacement property was $9.5 million and it had the $300,000 in debt, that doesn't mean you can't do a 1031. It just means you're not deferring all the taxes. I mean, the difference between 9.5 and 10 million, that amount is taxable.
Gotcha.
Right? Or if you find a property that is 10 million, but you only put 2.5 million in debt on it, same thing applies. You can still do a 1031 exchange, but that difference between 2.5 and 3 becomes taxable.
Yeah. Now, can you exchange one property for many properties, like on the replacement side, and vice versa too? And if I sold 3, but can I buy 1 as long as it meets the requirements of the 3 together?
Yes, very good question. The answer is yes. You can replace a property with more than one, and you can replace multiple properties with just one. Sometimes, the potentially complicating factor with holding 10 that rolls into 1 is they all have to be titled the same.
Mm-hmm.
So the entity that sold has to be the same entity that purchased it. And so that's an important thing to pay attention to. So the couple things here on this that are really important is you have to use a qualified intermediary. If someone sells their property and the funds are in their bank account, then the 1031 is not an option for them. Okay, you have
Okay.
to use a QI. You have to
Right.
follow the rules. There's some rules I'm going to show here in a minute. And in order to defer all taxes, you have to spend all the money you took in, and you have to use all the debt.
Now here's a pretty much related question, but a slightly different subject. What happens if someone at the end of their life they have the last property they bought that wasn't an exchange, but they pass away, and then their heirs inherit the property through whatever in a will or what have you. Do the heirs inherit the 1031 exchange requirements or do there's a cost basis when you inherit a property, the cost basis at the time of inheritance, does that override that, or have you ever had that happen before?
Yeah, very good question. It happens all the time, sure. So
Hmm.
if you own an apartment building
Hmm.
and you pass away, your heirs will inherit that property with a step up in basis. Whatever your basis was at the time you passed away, it will
Hmm.
be step up to the current market value. And so, and then that's the same whether you're holding a property, a physical property, or a DST, by the way. And again, we'll get to that, but there's a step up
Okay.
in basis. And that's one of the big tax advantages of doing a 1031 exchange is I'm going to keep deferring my taxes, and then I'm going to leave my DSTs to my children, and they'll get a
Hmm.
step up in basis, and it effectively, ignoring estate taxes, but in terms just of the capital gains, it will defer all those capital gains and recapture taxes for them. So they'll be able to start fresh. And the other thing that
Gotcha.
you mentioned too, you mentioned step up in basis. It's a very good question, but it's also with a 1031 exchange, particularly if you have, um, uh, um, particularly with DSTs, if a property is fully depreciated, the relinquished property has no more depreciation left, so the income from it is not very tax efficient. Well, when
Hmm.
you do a 1031 and you buy a new property, you have a new depreciation schedule too. Very important.
Okay.
So not only is
Yep.
it deferring the taxes, not only
Hmm.
are you giving your heirs that step up in basis potential, but you also have a fresh depreciation schedule. So the income from that property is now more tax advantaged. So
Nice.
there are a lot of reasons to do a 1031 exchange. A lot of reasons. Um, anything else on that topic, Gary? Or
No,
anyone
that's
else?
good. I appreciate the insight. Yeah.
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 And so replacement properties can be anything. Again, um, rental homes, apartments, condominiums, shopping centers, raw ground. It's also interesting to point out that water, air, and mineral rights are also 1031 exchangeable.
Okay.
And also leases of over 30 years, such as a cell tower lease, is
Hmm.
1031 exchangeable. So I've been reaching out to those throughout EXP who may have clients that have cell tower leases on their property, they have cell tower assets on their property, and splitting them off from the real estate is a good idea because the multiples are much higher for cell tower leases than they are for farms or other types of income. But
Hmm.
then the sale of that cell tower lease is also, if it has a long-term lease on it, is 1031 exchangeable. Um, so really the point here is just it's really worthwhile to ask questions. And it's really worthwhile to have resources that can help when you have a client that has
Hmm.
either already in commercial real estate, or maybe if it's a residential agent that wants to expand what they're doing and have more of their clients real estate business and get involved on the commercial side. There are certain questions that you can ask that will put you in a good position to maybe gain some of that business as well.
Hmm. Yep. And there are a
Okay.
lot of places. There are a lot of assets, asset classes that have. I mean, like the corner in East Coast, you've got Middle Atlantic like Sheets. Then there's Wawa. The big corner gas station, Burger King. And small convenience store. Some of those are like 99-year leases. So I mean, it's crazy. There's a lot of hustles out there.
There sure are. You asked earlier about the number of replacement properties. There are some rules about this. So when it comes to identifying replacement properties, for the exchange to be completely compliant, it has to follow one of these three rules. The first one is 3 properties. If I sell an apartment building today for $1 million, I can identify up to 3 replacement properties without regard to the value of those 3. So I sell a property for $1 million, I can identify a $200,000 gas station. I can identify a $10 million condominium building. I can identify a warehouse. It doesn't matter what their value is, but those are the assets I can identify. The other, because it becomes a little bit of a challenge. This is one of the challenges of a 1031 is you only have 45 days to identify what your replacements are. I always advise starting early and getting a good sense for what a client would like to use as a replacement early. The other way to do it, if you don't want to limit yourself to 3 properties, you can identify any number of properties, 50 properties if you want, but the total aggregate value of those 50 properties can't be more than 200% of the relinquished property. The idea there kind of makes sense. I mean, the idea is that for the 1031 exchange, the IRS wants the seller of the relinquished property to be focused on this is what we're going to do. Because if they didn't have these rules or limits, you could identify potentially infinite number of replacement properties and go about trying to find get a closing on one of them. So the 3 property rule is most common. The 2 is next. So any number of properties as long as it's not double the value of the sold property. And then the one that I honestly have never seen used is the 95% rule. Any number of properties regardless of value, but you have to close on 95% of those properties. I guess there was a good reason why they included that rule, and there's probably a good reason why they don't go about just removing it from the books, but it's there. It's rarely ever used. So,
okay.
and the identified properties can be a combination of things too. Again, getting back to my circumstance, my identified properties were 2 office buildings and 6 DSTs. So you can mix and match value, and you can mix and match the number of replacement properties. So
okay,
we go. So that's basically the majority of the comments I wanted to make on 1031 exchanges. I was going to move on to DSTs as long as anyone didn't have any questions.
Hey guys, if you have questions, let me check that chat box here real quick. 5 days. Okay, we got to those questions. Yeah, I'm excited about the DSTs. I'm gonna definitely take notes on that.
Great. Okay, so DSTs are before we dive in, they're tremendously useful. They're an instrument that is not widely known, but it's a very large market. Those who are familiar with them use them very well, but there are many that are not familiar with them. Tax professionals oftentimes are not. Tax attorneys, accountants, sometimes they're looking. I do these sorts of training things all the time where a potential client, and I encourage them to have their tax preparer on the phone too, so they can ask questions and they can get comfortable, because they're the ones that have to prepare the taxes when all this is said and done anyways. But this is something that's it's very useful. They've been around for a lot of years, but it's not one that's widely known, and I think you'll probably get a sense for why that is. Okay, so because I sometimes send this separately from the 1031 slideshow, again, a 1031 exchange is just a tax deferral strategy. We talked about 1031s in terms of having a relinquished property and a replacement property. And that's what most people think of as a 1031 exchange. And most brokers think of it that way too. Wouldn't you love to have the sale of the property and find them their replacement property? I mean, That's the goal, right? That would be ideal. So I'm not a competitor in that regard, but sometimes we need to have plan Bs. Sometimes deals fall apart. So a DST can be the primary replacement property. It can be a backup replacement property. So someone sells an apartment building and wants to buy a self-storage facility. And that's one of the three that they identify, but they probably need to identify a DST or two as a backup in case that replacement deal doesn't go through for whatever reason. So a DST is a Delaware Statutory Trust. It has nothing to do with the state of Delaware, other than I think that might have been the first state where the structure was formed. It's a trust, so it has a trustee and it has beneficiaries, like any trust does. It is similar to a REIT in that it is a trust that is formed for the purpose of owning real estate, but there's some important differences. A REIT can be publicly traded on an exchange or privately traded, but when you buy shares in a REIT, you think of it like buying shares of stock. Okay, you're buying shares in the company. That's what the investor is buying, is shares of the company. With a DST, you're not buying shares of the company. You're buying actually a fractional ownership in the real estate that the trust owns. So, again, if the DST is formed to own a particular multifamily property, an investor might be a 0.0126% owner of the property at 123 Main Street. And you would do the 1031 exactly the same way. The relinquished property proceeds are given to a QI, the qualified intermediary. They keep the investor out of the ditch in terms of paperwork. The replacement properties are identified in exactly the same way. It's just you're identifying this DST as the replacement property, or these three DSTs as the replacement properties. Okay, so it can be the exact same way. It can be, another use would be, using the example I said earlier, the sold property is $10 million. The one that we find that we replace it with is only $9 million. We don't really want to pay it taxes on that last $1 million. You can identify DST to fill that tail, or that bottom part of it. It can be a backup in case the replacement property deal falls through, or it can be identified for the tail, so you don't have to pay any part of the taxes there as well. So again, a DST it's a private placement security, similar to a REIT, but the important difference is it is 1031 eligible because the investor owns a fractional portion of the actual real estate in the trust. And by the way, the DSTs as securities, they are very regulated. I can spell all that out. I won't drag you through the weeds now, but for those who are new to it, might say, "Gee, I don't know. I'm not familiar with this." They are regulated by SEC and FINRA, and they have to be sold to a registered broker dealer like Great Point Capital. So there's a lot of oversight. And it looks like we have a question. Okay. DST owns a portfolio of real estate and an investor buys into a fraction of ownership. Yes, that is correct. The investor is a fractional owner.
So it's literally, instead of like a timeshare where you own a chunk of time interval in a property, you literally own a physical piece, almost like a share of stock or something, but it's the physical building.
Exactly.
That's
and
awesome.
Vanessa, you had a question?
Yes, I was asking, you said that if the person doesn't identify property within the 45 days, they can put it in this DST. Is there a time limit on how long the money can be? And I think Gary might have just answered, it's kind of like stock, I guess. And I guess that's kind of what you were saying. So there's no time limit on how long the money can stay in the DST is my question. Or is there a time limit?
Good question. Yes, it's a very good question. So the DST is, as far as the 1031 goes, the timelines are the same. You have 45 days to identify, 180 days to close. So that part is exactly the same. But the DST itself is the issuer or the sponsor, the one that forms the DST. Those are all words that are kind of used interchangeably. There's always a strategy for the property in the DSTs. I'll use a simple one. For example, let's say that the sponsor is, what they're doing is they're buying triple net properties like Walgreens or what have you, individual ones from mom and pop owners. They're buying them individually, rolling them into a portfolio, operating them for a period of time, and then their plan is to sell that portfolio to a REIT or some other entity that doesn't like to buy the one property at a time. They want to buy $50 million at once, right? So the strategy for this particular hypothetical DST is we're going to buy individual properties, roll them up, improve them in some way, and sell them and provide our investors with income, and then sell them at a profit. Most of the time, and all of that strategy is spelled out in a private placement memorandum, kind of like when a stock is issued, you have this prospectus, right? Big thick book that no one reads. Well, there's a private placement memorandum for DST that spells out who's forming the DST, what the debt is on the property, what properties are in the DST, what the management company is, what the strategy is, and when they're going to get out. So the sponsor, this is a bit of a long-winded answer, but I think it's all stuff that is important to point out. So the sponsor has a strategy going in when the DST is formed. We're going to roll up these triple net properties. We're going to own them for 3 to 5 years is usually the time frame. And then in that time frame, they're going to sell the properties in the DST. And then the investors can have all the same 1031 options again. They can just take the proceeds and pay their taxes. They can go buy individual real estate. They can do a 1031 into other DSTs, all those sorts of things. But the money that you invest in a DST, there are some liquidity provisions, but they need to be thought of as a long-term investment like any real estate. So there's not a set period of time that the money's in the DST, but it's usually in the 3 to 5 year time frame. I've had some of my DST investments liquidate in as little as 18 months. Does that answer your question, Banana?
Yes. Thank you so much.
Probably more than you were asking for, but
No, that's okay. Better, more is better than not enough.
okay.
Yeah.
Information is power. So.
And Charlie also asked how many DSTs are out there. That's a good question too. All these are good questions. I appreciate them. I would say that at the moment there are about 50 different DST issuers on our platform at Great Point Capital. So we have a pretty big platform. We cover pretty much the whole gamut of the industry. So there's 50 issuers and maybe 100 to 150 different DSTs at any given time.
Are the DSTs? Okay, I'm sorry.
They'll be in any sector. So they're self-storage, they're a multifamily, they are student housing, they're warehouses, they're senior housing, you name it, there's a DST for it. And then it's anything commercial. And some of them are development deals. Some of them are raw land deals. There's one that I really like that they warehouse ground for home builders. Home builders they get penalized. Their stock price gets pummeled if they're holding too much ground on their balance sheet. So they pay others and they will tell this particular group where they want to build houses. And so this DST, what they do is they raise money, they go and they buy ground and hold it for up to 2 years, and then they sell it to home builders. So there's no income from it, but it's a growth play. So there are DSTs for any growth or any risk tolerance, whether it's income or growth or half and half or what have you.
Okay. What's by the way, that was going to be my question. The different DSTs have different focuses, and obviously it sounds like they do. But I do have another question. I interview a lot of people on my podcast, and for example, there's several groups out there that focus on self-storage, and they all have their own unique formula. Like one group, they look for old mini malls and things like that that are just, now, obsolete, and they'll take those, convert them into self-storage, and that's their sweet spot. They get these good deals, they convert them, and it's easy to rent. But for those guys, let's say one of those guys wanted to take what they had and put it into or create a DST. Would they come to you for that, or is it you need an attorney just like you would need for like a syndication type thing? Or I guess there's a process for that, right?
Good question. Yes, yes. I would recommend going through a broker dealer like Great Point Capital for sure.
Okay.
For a number of reasons. One is we do sponsor and we do originate deals like that. Since we're in the market every day, we have a very good sense. Now, I'm not part of the deal structure team, but our deal structure team is very plugged into what is selling, what is not. Some DSTs are structured very well and they're attracting investors. Others, there may be some flaws, relatively speaking, in the structure of the deal that's causing investors to not really accept that DST as well. So going through a broker dealer that specializes in these types of alternative investments is really the way to go. It's not more expensive. It's minimally have a good outlet.
Weird.
Yeah. A couple more
Sorry.
questions. Did I answer your question, Gary?
Yeah. Now, what would be the benefit of someone wanting to do that? Like a group of guys who were doing, self-storage. I mean, I'm gathering because I guess they could actually raise capital from doing that. Or I guess I'll just let you. Is there a reason why or benefit why they would want to do that?
Yeah, there are. Typically, DST issuers are typically companies that have been developing or acquiring or managing real estate for a period of time, sometimes a long time. And so think of the DST issuer as, they might have started way at the beginning by raising money through friends and family and country club, and then they ran out of funds with that. So now they started to syndicate. And then so they said, well, gee, now we're going to go out and we're going to cast the net a little bit wider, and we'll take $100,000 to $200,000 investments from a number of folks out that way. And that works for a while too, until now they've got hundreds of investors that they're paying attention to, and they're pulling their hair out because instead of managing real estate, now they're managing investors. So
Yeah.
they eventually get to the point. It's a little bit like the same question of, does a company go public and raise funds from the public, or do they go to private equity or a venture capitalist? So usually there are internal reasons for a company to want to do this. This is kind of tapping in raising money in a more public way, in a retail way. Oftentimes, companies that are involved in real estate will want to diversify. Maybe you'll do some syndications, you do some DSTs. You don't put all your eggs in one basket in most things in life, and so that's typically what happens. Now, in today's world, I would say if someone doesn't have a proven track record in the space that they want to be a DST issuer, and they can't show that they've gone full cycle. I'll use your example. They were buying big box stores, abandoned Kmart's, and they get big tax benefits. So they're going to buy abandoned Kmart's, turn them into self-storage, and run them. Well, if they've done that maybe once or twice and they have a good eye for it, but they've never gone full cycle, they've never sold them and given money back to investors, if they've never gone through any of the cycles in the economy and that sort of thing, then they probably are going to have a hard time raising the money, because one of the first things that investors are asking, and like I'll get to Charlie's question there. It's important to look. Charlie asked, "Is it important to look at the private placement memorandum to assess the risk?" Absolutely, it is. Now it's 300 pages, so most people don't. They read the executive summary, but the registered reps like myself and the investors that I might bring to the table are asking questions of the issuer like, have you done this before? You know, what's your team? Who's your team? How have they done that? How do you make decisions on properties to buy? What's been the internal rate of return when you've done this in the past? And so if groups don't have ready, tangible questions or answers to those questions, they're going to have a hard time. They're going to have a hard time raising money as a DST. So, you know, yes, it is a viable option for raising equity, but it needs to be used judiciously because it's not easy. And but I also asked, can anyone invest in a DST? They have to be accredited investors, and that definition is a bit of an old one, but the definition as it exists now is that be worth at least $1 million and or have an income of $200,000 a year for the last 3 years, or $300,000 for a married couple. So so the idea there is not to exclude anyone from the party. It's just that since these are private placement securities, regulators want to make sure that not only is the paperwork complete in terms of divulging all the risks, pros and cons, not only is the broker-dealer conveying all those things properly, but we're only selling them to relatively sophisticated individuals. They're really going out of their way to make sure that relatively less experienced or sophisticated, I must say experienced, investors are not getting involved in something that they would later say, gee, I didn't know what I was doing. So the minimums are usually on the order of $100,000. Averages are higher than that, only because there are some fixed costs associated with this, like having a lawyer review it, having perhaps accountant get involved with it, that sort of thing. So there are, and paying for the qualified intermediary. Those aren't big numbers, but the smaller the investment, those fixed expenses, transaction costs, become a higher percentage. So, but typically speaking, 100,000 or so is usually the minimum, and most often that 100,000 is like the example I mentioned earlier, when someone has a relinquished property for 10 million and their replacement is 9.9. Well, they don't want to pay taxes on the last 100, so they fill that in with a DST. And the other question then is that gross or net of over 200? It's gross income.
Okay. Wow. Well, I'll tell you what, this seems like a really good viable alternative if you go into traditional route of just finding another property, whether it's a multifamily, a farm, or a gas station, whatever. If getting into a DST is probably a much, much easier option, or a great alternative, I should say that at least, you know.
It really is, and there's a couple other things I'll add to it. Again, I think that offering your own experience is valuable. I got involved with them as an investor first. Mm-hmm. I had such a good experience that I went back and got my Series 7 and I got involved with it. So when I had my storage business, virtually all my assets were concentrated in one sector, self-storage, in one location, St. Louis, and I had recourse debt on all the real. I owed a lot of money. I personally had to guarantee a lot of debt. So, but the DSTs, what they allowed me to do was be in 6 or 7 different sectors. Now I'm in student housing, I'm in warehouse distribution, I'm in multifamily in Washington, D.C. I mean, all these different things. They're all over the country. So I've got diversification by sector, by location. All the debt on the properties in a DST is non-recourse to the investor. So whereas I had to personally guarantee all the debt on my storage properties, my DST investments now, I don't guarantee anything. So the assets in the DST are the security for the debt that's on the DSTs. So in a lot of ways, it's a lesser risk than what I had before. I'm more diversified. I don't have to guarantee loans. I'm also able to make smaller course changes too. Whereas when I sold my business, it was the biggest transaction I've ever had. Well, then once I have 6 different DSTs, they go full cycle at different times, right? So the subsequent decisions about doing 1031s and so forth are with a much smaller part of the whole. So you can make small course adjustments if a client's circumstances change and they really do need some liquidity, and they can choose to pay the taxes on a small part of it as opposed to the whole transaction.
Right.
You know, the step up in basis is a huge plus. So they're very estate planning friendly, and I would say, you know, I have a few things I was going to point out. How can they be useful to you? Well, maybe I should ask you if there are any questions first. I have a couple things I want to describe as to how they could be useful to you, but I'll answer the questions first. How long does it take to set up a DST? Well, I'm assuming, Banana, the question is how long does it take to kind of make the investments, or what do you mean by how long does it take to set up a DST?
So you said, so I know that 45 days, if you have a 31 exchange, you got to find a property or you got to invest it in something else. So my question is, how long does it take within that time frame to set it up, or, you know, before somebody, you know, they don't want to do it last minute? That's kind of what I'm asking.
I get it. I always, like everything, it's always better if you start early. So I love talking to a client before they sell the property they're getting rid of. You know, start the conversation then, so that everything's not at the last minute where things get emotional, right? But that said, sometimes, you know, we're problem solving. We're not planning, we're problem solving. So someone's 4 days away from they've sold their property, they're 4 days away from closing on their replacement, and the deal falls apart. So those things can be done in very short order. We can, if we have an accredited investor, we can find a DST that meets their needs, get the paperwork done, get the closing in as short as in as little time as a couple days. That's on the short end. I mean, but usually, you know, in a comfortable pace, you would really rather have a week or two, or longer. But if need be, it can be done very quickly. And what I like to do is, so that no one's missing income, for example, if you're closing on the relinquished property on today, the 14th, if we started the process for your DST investments 2 weeks ago, then you close on your sale today, you can probably close on your DSTs tomorrow and start earning income immediately. And then, does that answer your question, Banana? Okay. And then Charlie asked, can a DST fail? Is there a precedent? Also very good questions. There are risks. The risks and returns. Return is also another question that's often asked. Well, how much money do I make? Well, the returns are commensurate with the underlying asset. You know, I would say that DSTs, I would argue that a DST investment is probably a little bit more likely to have a higher return than what I would be able to realize if I was buying those assets myself, because the companies that issue DSTs are in the market every day. They have tons of deals to evaluate. They're professionals at sourcing deals. They get the best debt. They have access to the best properties, much more so than I would have as an individual. So I believe that there's less risk and probably a better opportunity for return as well, because there's a pronounced, a defined strategy for the exit. They have relationships with who will be buying from them. So those sorts of things. But as a part of that, the risk that needs to be understood too is the same risk that there is in the underlying market. If a DST has apartment buildings in it, well, it doesn't have less risk just because it's in a DST than it would if we had bought it ourselves individually. So it's the same risk, and properties can be mismanaged. Typically, the debt on the property they're not highly leveraged. So DSTs are, in today's world, 40 to 50% loan to value. So they're not highly leveraged. So they can withstand losing a tenant or two. They can withstand a slowdown. You know, if they're 80 or 90% debt, and they're not able to make a debt payment, well, then the bank can take it back, right? So having less leverage equates in a way to less risk. DSTs are, I can't say they never fail, they can, but it's usually not for the real estate. There have been a very, very small number of real problem companies, and for the most part, those companies have not been able to stay in the business because it's very competitive. So more likely than not, if there's a problem, the issuer is they underwrite conservatively. If they say they're going to pay you a 6% distribution rate paid monthly, they really could probably pay you 7%. But they want to under promise and over deliver, and they want to have cash on hand so that if they do have a client that moves out or a tenant that moves out, or they do have a insurance claim that they have to pay the deductible on or what have you, but not going back to investors to ask for money. And if there is a problem with the DST, usually what they'll do is they'll pare back on the distributions. They'll say, okay, we're gonna cease distributions for 3 months, or maybe we're going to cut them back for a few months because it didn't lease up as fast as we thought, something like that. So for the most part, the same sorts of risks are evident in a DST as there are in the underlying real estate, but there's a steadier hand on the wheel than there is with just an individual trying to replicate that sort of investment. Okay, thoughts on that? Anything to add to that risk conversation or risk question? Let's see if there's anything else on here. I was just going to say the benefits of doing a 1031. If you're buying an entire property, you have to locate the property, do due diligence on it, put financing in place, which again is likely recourse. You have to buy insurance. You have to have a management company. You're involved with the accounting, the leasing. Those are all things that are part of owning real estate, right? When buying a fractional share of a property, the investor has access to a wider range of replacement properties. They're prepackaged, non-recourse. All the due diligence is completed. The title commitments are completed. By buying assets along with others, it's certainly possible to purchase higher quality assets than one could by themselves. And there's no day-to-day involvement or responsibilities. Let's see. I mentioned some of the other things here too. Diversification, less stress. There's more assurance that the exchange will close. When doing individual deals, you're selling property A, you're buying property B, things could always happen. Well, with a DST, when you invest in a DST, the property's already acquired. The debt's already in place. Everything's already there. So there's really virtually, I don't want to say the odds are zero, but they're pretty close to zero that if you identify a DST that you want to use as a replacement property, very, very high assurance that it's going to close. Another thing.
The thing is you're also, I mean, I know this is a general statement, but you're probably tapping into some really good management practices. I mean, these guys aren't doing these things if they're not any good at it. So everybody wants to manage their properties when you first invest in it, and until they realize what's involved, like all this gray hair, right? But doing it this way, I know it's passive.
I used to have gray hair.
Yeah, there you go. It's definitely more passive. And a lot of people think, well, if it's more passive, that means I'm paying more in fees and stuff like that. I'm not going to get a great return. There's greater return. I think these returns, I don't have one myself, but I'm willing to bet they're still pretty good,
Absolutely. I think that the buying better quality assets, having access to assets you wouldn't have individually, the management expertise absolutely makes a difference. And then having an exit strategy too. One of the things here too that I wanted to mention that's kind of a subtlety, but the ability to invest exact dollar amounts is not a small thing. When we cite examples, we use round numbers. Sell a property for 10 million, has 3 million in debt. Well, the one thing you know for sure is you never sell a property for exactly 10 million, or you have exactly 3 million in debt. So if your replacement property is, you sell a property for 9,372,000 and XDX pennies, well, you can buy exactly that number of pennies of a DST. So you're not buying too much, you're not buying too little. And sometimes that can be really, really useful when trying to, for example, again, using my example, I had 8 storage properties, but they all had different debt levels on them. And so my need for the 1031 exchange was to meet the debt requirements for the portfolio as a whole. So then when I bought a property, I might be able to put a certain amount of debt on that property, but it's not the exact ratio of loan to value as what I sold. So there can be a little bit of tweaking that's necessary to get the exact dollar amounts right and the loan levels right. And that can be done very precisely with, and that's kind of a subtlety, but once someone has done a couple 1031 exchanges, it takes on a little more significance, the ability to invest exact dollar amounts.
Okay.
Let's see, we talked about swapping until you drop. Estate planning is very helpful there. You know, again, I keep coming back to my case, but I have 3 children. None of them were interested in self-storage, and so they don't have any decisions to make. When my day comes, you know, with the stroke of a pen, each one of them will get what they get, and they don't have to do the same thing. They can make different decisions. It's just very friendly estate planning friendly. Same example we had before. And we talked about the risks. It's always possible that the tax code laws can change. I don't know how anyone has an opinion about they always talk about doing away with 1031 exchange. I can't imagine the mayhem that that would cause in the U.S. economy to actually make any material changes there. So I just don't think that there's much risk of that. Let's see. Words. How about questions? Any other questions?
It looks like we're okay. I'm just so really, Great Point Capital is a resource for the DSTs, and I guess there's others out there. But you do have to go to a broker that offers these, right?
Yes, and not all of them do. Not all of them
Gotcha.
do. So
Okay.
yes, let me go through a couple of things that how can this help you? I'll go through that
Mhm.
and then what questions to ask, because I think
Okay.
those are important. What service can I be to you? Like education, I'm happy to just like we're doing tonight. It's a big part of what I do. Most of my relationships are it takes a while. There's a lot of runway to developing a relationship with someone who then is going to introduce you to their client. So education is a big one of them. You know, the other thing that this can do, I don't know what percentage of the group is involved primarily in residential or primarily commercial, but for those who are on the residential side, I think that, you know, there's certainly the potential to get involved with your clients on a commercial side of things as well, and deepens your relationship. And you can be viewed, even if you don't have all the answers. No one does. No one has all the answers. I don't have all the answers on every DST either. I can get to a certain point, and then the questions get to the point where I'm like, you know what? Let's get the experts who actually are buying these properties on the phone, and they will. They'll get on the phone, and the person at the DST that is actually buying the properties, he'll get on the phone with your client and describe their strategy, that sort of thing. So you can be seen as the one that brings value to your client by bringing in, you know, information resources. As a practical matter, I think that in some cases it can get you more listings than you might have otherwise. You know, if someone is contemplating selling a commercial property or rental property, but they express a concern about taxes, or they express a concern about what they would do next, or they don't have an exit strategy or what have you, just being able to say, hey, look, there are options, and let's get a guy on the phone with us and kind of identify what some of those options are. If they don't appeal to you, okay, but maybe they do. And I have helped people get listings that they otherwise may not have been able to resurrect, Or if you're on the buy side, if you have a buyer that's approaching, that has a property that they would like to acquire, and the seller's reluctant for any one of a number of reasons. Usually it's taxes or what comes next, or they don't know how they replace the income from the property. That's been a thing as well. With an introduction, you may find that a seller is more amenable to receiving or entertaining an offer from your client than they would have been otherwise. Or maybe they're more amenable in terms of they'll take a more rational price. I mean, most property owners will, sure, I'll sell for a ridiculous price, but if you can show them, a path to the sale at a rational price, they oftentimes can be more reasonable in what their price expectations are. You can also find circumstances where maybe your client is selling a commercial property and the replacement deal falls apart. Well, now your sale falls apart too if they don't have their replacement backup. And DSTs can be a backup for that, and it can keep deals together that otherwise might have fallen apart kind of late in the process.
Okay.
And then the last couple of things I was going to say too, questions to ask. So what do you ask if you have a client or prospect? Do you have any commercial real estate? Have you ever contemplated selling? Have you sold it? If you have sold it, where are the proceeds? Are they with a qualified intermediary? If you're already taking in the proceeds, there isn't much we can do. Is it a business? If they're selling a business, the real estate portion we can handle with a 1031 exchange, but the non-real estate gains can be deferred also, and that's an important thing to know. Depending on the sale, how they structure the contract of their sale, they'll have to say how much of it's real estate, how much of it is goodwill. Opportunity zones are another security that we hadn't talked about tonight that they can use to defer the non-real estate gains. Someone sells sells an XYZ business. I don't know. I can't think of one at the moment. Well, just even with my self-storage business, a certain part of the sale was 1031 eligible, but some of it was goodwill, which is just the value of the contracts you have with the client. That's not a 1031 asset. That's goodwill. And we can also defer those gains through the use of an opportunity zone. So if you have a client that's selling a business, you might ask them, are you deferring everything? Are you deferring the non-real estate gains too? And I almost guarantee you that they're not hearing those questions from anybody else. If you're asking them, you're the only one asking them. And
Yeah.
I just, as sure as I'm sitting here, that will call you some favor. You know what I mean?
Yeah. Now let's say Charlie finds somebody that needs to find a replacement property, and they're running out of time, and he brings somebody to Great Point, and they end up buying into one of the DSTs. Is there a commission that can be earned just like you would have selling a property, or how does that work for?
Very good question. We'll use that example. Charlie has a client. The client, let's say they're doing a 1031 exchange. They've got the sale of the property. They were going to buy something, but that deal fell apart. So he introduced me to the client. The client ends up buying DSTs. Okay. First of all, I don't ask for any referrals. First of all, from agents. I am not able to. I'm big on financial securities. You can't pay referrals like you do in real estate. So that's one thing that if you can get both sides of the trade, then God bless you. You should do it. But if you can't, and the client ends up doing 1031s or opportunity zones, by law, I can't pay referrals for someone that introduced me to a client that ended up purchasing securities. So that's just the rules. So what I can do is I can hopefully help you close more deals that may have fallen apart otherwise. But what I can't do is, and if I am able to help you get a client to the closing table. Say a prospective seller who now is interested in selling because of the conversation with you and me. Now they're interested in selling, and you sell their property. I'm not asking you for a piece of that commission.
Mhm.
All I'm asking for is a chance to give them a solution on their replacement property.
Okay.
Yeah, but the clear rules are, man, you lose your license, you lose. They really come down hard on financial services people that pay referral fees to non-financial services people. You have to be serious.
Gotcha.
If you're a Series 7 license, that would be different. But assuming
Mhm.
that no one's, we're in the conversation is Series 7 license, but I'm like,
Okay. Okay. Any more questions, guys? That was a lot. Tonight was like a college education class, you know. So that was awesome, Jim. So what's by the way, I may want to make a comment. Everybody here is a real estate, which means you're should study marketing on a regular basis and develop some expertise at it. If you notice in all of Jim's slides, well, unless it's below the line here on the last one, on the left he had his contact information, name, email, phone number on every slide, you know. So keep that in mind when you're putting presentations together, booklets, things like that, everything, every page should have your contact information. So I thought that was pretty neat. But really, just the content itself. I mean, if you guys could please give Jim a big pat on the back, clap or a hand raise or even a thank you in the chat box. Um, that was a lot of golden information, you know. Uh,
well, good. Thank you for that, Gary, and thank you. Already got many thank yous in the chat box. You're very welcome. I'm glad to help. We got my name, my number. I'm on LinkedIn. We welcome a chance to connect on LinkedIn. My website should be up here in a couple of days, and that has resources as well. And I'll share that with Gary, and he can pass that along. And so if anyone has questions, they don't really want to get on the phone with this guy Whitesides because they don't know who he is. My website will have a lot of good information on it, like these presentations, and a background of what the regulatory framework is. That's usually a question that people like to get a sense for: is what's the regulatory framework? Who's overseeing this? So my website will have all that stuff as well. So I'm glad to help anytime I can. Anyway,
you got it. And thanks to Charlie too for making the introduction. So I forgot to mention that in the beginning. So Charlie, because of Charlie, all this happened tonight. So thanks, Charlie. Yeah. Mr. Humble. So okay. Okay, guys, city going once, going twice. Let me just check here real quick. Yeah, they're all thank yous. Thanks guys for doing that. And Jim, thank you again. I'm sure we'll see each other again. And let's
I'll talk to you
see.
tomorrow. Actually, I'm talking to you tomorrow, Gary, for your podcast.
Well, that's right. Hot Tickety Dog. Okay, perfect. So this should be a good podcast. Obviously, one direction. There's not going to be people asking questions, but I'm looking forward to that. And everybody, thank you for participating and learning, listening, learning, and asking questions and taking notes. Again, this is the kind of stuff you can use to share with your clients. You don't have to be the expert. You just have to know about what it is and who to contact. And now you've got a contact in Jim Whitesides. And and most of you are EXP. He's an EXP too. If you're not an EXP, you can still contact Jim. So this is the class is open to everybody. We got people in from multiple brokerages, and same thing on the podcast. It's we have people in from all over. So listen, you guys take care of yourselves. I'll see you on the one-on-ones. Again, thanks for participating, Jim, and everybody here in class. God bless you and all your loved ones. And I will see you in the next Monday Night Live class. And I'll see you on the one-on-ones.
Hey, Gary,
Thank
can
you,
you hold
Tony.
on a
Thank you,
minute for me?
Jim.
Gary, can you hold on a minute for me?
Yes. Yeah. Hang on.
Okay.
Thanks, everyone.
I'll duck out. Thank you. Have a good
All right,
evening.
Jim. Have a great night.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.